Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. And this is Trading Index Options at its new time. Now, this is the first time I've had the opportunity to jump in on this new time and teach this Trading Index Options. My thanks go out to Connie and Barb and others who have been teaching this for me while I have been out on the road. And thank you all for being here with me today in this discussion. And I know that we've got a bunch of folks that are coming over. We talked a little bit about this particular webcast last night in night number 2 of our options or advanced option strategies virtual workshop. So if you've come over from that virtual workshop and this is your first time in this event, welcome to you. If you've been here on a regular basis, welcome to you as well. We're glad to have you back. If you're in the recorded version, thanks for joining us there as well. Be a part of the conversation. Leave us a comment in that recorded session in the comment section, and we'll get back to you. And with me in the chat right now to help facilitate the conversation there in the chat is my good friend Barb Armstrong, who is a phenomenal educator, 20-plus year veteran of the financial markets. She is Canadian, but don't hold that against her because it's, not such a bad thing. She is very polite, and I think that's a good thing to think about. So we're going to talk a little bit about managing a couple of different trades. One of the reasons why we moved this particular webcast to this later time slot during the day is so that we could talk a little bit more about managing shorter-term trades that might be well suited or at least suited for index options. And so I've got an example of a 0 days till expiration iron condor that I wanted to talk about today. So that'll translate to what we were discussing in the advanced options strategies virtual workshop last night. And we're also going to talk about our 14 days to 7 days short vertical spread strategy on the SPX index. So let's jump in here really quick. We'll take care of a couple of quick housekeeping items, and then we'll jump right into the discussion. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular security or strategy or account type or anything else. Remember that investing involves risk, past performance, no guarantee of future results. When we talk about index options and the equity options for that matter, make sure that you understand that these carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. And we're going to talk about the differences briefly, the differences between equity options and index options in just a minute. But I wanted to make sure that you are aware of this fact. If you are short an American style equity option or an American style index option, that short leg or that short option can be assigned at any time up till expiration, regardless of whether it's in the money, at the money, or out of the money. If you are short an European style option, which is primarily on the indexes, and a lot of the big indexes, not all of them are European style, but those that are European style, those European style options may not be exercised until expiration. Therefore, it removes that early assignment risk. That becomes a potential benefit depending on the type of the strategy that you might be using. But recognize that if you aren't sure whether or not an option is American style or European style, just be aware of that fact that they can be assigned early in American style options. Now, Paper Money, that we're going to be using the Thinkorswim desktop software platform here, and specifically the Paper Money version. The Paper Money version of the Thinkorswim platform does not facilitate the early assignment of options, whether they're European style or American style. So as you move your practice from paper trading to live trading, that is something to pay attention to as well. It's also the Paper Money version of the platform, not a guarantee of future success out there in the real world, although it's a great way to learn and a great way to practice. Remember that technical analysis, probability analysis, both of the things that we're going to discuss today, those are theoretical in nature. They are not guarantees as to what the market might do or what might happen in the future. And Schwab doesn't recommend the use of technical analysis or really any single method of investment research as the only way to look at the market. So those are some of the things that we want to pay attention to, some of the characteristics of and discussions and considerations about what we're going to talk about in this discussion today. So let me do this really quickly here. I want to pop over to some of the strategies that we might use and we'll talk about when we talk about index options. And you'll notice that these reflect a lot of the things that we were talking about in the Advanced Options Strategies virtual workshop. And I'll show you where you can find more information about that if that's something that is of interest to you. But we're going to talk about verticals, iron condors. We've talked about butterflies in this webcast. We've talked about hedging. These are some of the strategies that maybe are uniquely suited, or not necessarily uniquely suited, but well suited for index options. Now, when I say well suited, I'm not talking about suitability for you as an investor. When I'm talking about well suited in terms of index options, I'm talking about the fact that index options have some characteristics that may make them beneficial in certain types of strategies, especially European style options. So vertical spread, say for instance, a short vertical spread. With American style equity options, there is the potential to be assigned early. And early assignment in a short vertical could put a trader into a position of taking maximum theoretical loss in that trade on that early assignment. But if you remove that early assignment risk, then it makes perhaps that short vertical spread a little bit more versatile in terms of using that strategy. You're using that particular instrument. So we'll talk about that. Same thing with iron condors, because we're talking about two short vertical spreads. We'll talk a little bit about butterflies, not necessarily in this discussion today, but over the course of this webcast. So remember, as we talk about index options, they are only one way to approach the market. I'm not recommending and never do recommend that something is the best or the only way to do something. Now, let's jump over here to the Thinkorswim desktop software platform. Let's talk a little bit about what's been going on with volatility, because this is maybe an indication of some of the things that we might use as a means to choose a particular strategy. The VIX, the volatility index that measures option premium on the SPX, saw a little bit of a spike today, but it certainly is bleeding off pretty quickly as we get to the close. We're a little bit less than an hour away from the close of the market here. We're getting down to that time where we may look at, seeing a little bit more volatility at the end of the day, but at the same time, the VIX seems to be bleeding off and settling down just a little bit. And it's come way down in the last 2 or 3 days since that big spike that we saw early in the week, that big spike up. And then last week, we saw that big spike up in the VIX. So the VIX back down, sitting right now at the 19 handle, and really kind of coming back down very, very close to its moving average in this particular case. This happens to be a 30-period moving average, which is interesting because we've got the VIX itself is a 30-period moving average of in the money, at the money, and out of the money index options on the SPX. All right, so now that we know where the VIX is, that it has been high and it seems to be falling, that certainly would benefit potentially trades that have a volatility component. So the first thing that I want to do, because we are getting close to that kind of time frame within the day, is I want to look and see what has gone on with the indexes today. So I'm going to bring this into my index grid, and we're going to look at that index grid here and kind of see what's going on. And it's really interesting. I've been watching this over the course of the last few minutes here as we were getting ready to go. Here's the S&P 500. We see that the RSI kind of bleeding off a little bit today, but we saw a pretty good move to the downside that then has been seeing a bit of rally. It's been a little bit of buying pressure coming into the SPX here as we get into the end of the day, maybe holding it right at that level of support here. So not necessarily ending up with a really significantly lower close. Yes, maybe a lower close from where it opened, but again, right on that level of support. Now, the day is not done yet, it could still be significantly bearish. There is still time for the market to make a big move. Taking a look at the NASDAQ, kind of doing the same thing here, kind of sitting right at the apex of this little triangle, coming off of that previous resistance level, rallied up into the resistance, now seems to be pulling back, but a little bit of buying pressure, maybe a little bit less buying pressure to the upside than we were seeing on the SPX. We take a look at the Russell 2000 here. And if you were with me in my futures webcast yesterday, we were looking at the Russell 2000 kind of doing this, downside move and pushing to the downside. In fact, that's exactly what it did. Seems to be bouncing up off of kind of this area of support, maybe right off that 50 period simple moving average. So a little bit of buying pressure pushing the Russell 2000 back up. Still a pretty long red candle today, but the momentum kind of coming back in. And I wanted to do this real quick because I wanted to maybe change our time frame and see what's going on in these last few candles here. Here's today's movement, down, down, down. And then we've seen it reverse, and now it's starting to move back up. And we've got a pretty good push to the upside. In fact, we had, if we kind of zoom in on this time frame right here, and I'm going to expand my RSI. For those who are technically inclined, we had a little bit of a bullish, this is a pretty good example of a bullish divergence on the RSI. I know Barb teaches this. I know Cameron May teaches this in the Advanced Options Strategies, the Advanced Charting Techniques webcast. I know Barb teaches this in the Getting Started with Technical Analysis series of webcasts. But when you have price that's moving down, but a momentum indicator like the RSI that's moving up, that's kind of priming the pump for a potential return or reversal. It doesn't guarantee it, but that's what happened in this particular case. Momentum starts to kind of bleed in here, starts to trickle higher, and then boom, we get the catalyst that moves it to the upside. That catalyst in this case, you see that big green candle breaking out of that diagonal trend line there and shifting that momentum to the upside. So momentum's been on a run, pushing the Russell 2000 up, but not yet necessarily eclipsing back that downward move that we saw. So as we get into the end of the day here, a little bit of bullish momentum coming back in here and moving back to the upside. So let's go to the monitor tab really quickly and take a look at the circumstance that I have going on in this particular case. So we've got a couple of different trades going on here. The one that I want to look at really quickly is this one on the XSP. Now, this particular index, the XSP, is the micro S&P 500 index. So these options are subject to the movement of the XSP, but they're going to move essentially the same as the big index, the SPX, the S&P 500. The XSP trades with the same movement. It's just a tenth of the size of that big index. So you can see that the price of the XSP is 669.32. The big index, we would just move that decimal point over, and it would be 6692.6 if we moved that decimal over. So smaller contract or smaller size index means smaller contract notional value, smaller option costs, and this is becoming a more liquid product. So what I did this morning is I created an iron condor around price movement in the XSP. So I'm going to come back over here to my charts really quick. We're going to go to the single grid, which is my playground, if you will. And we'll take a look at XSP. There's the SPX. Here's XSP. Looks almost exactly the same. And I'm going to bring this down to a shorter term time frame. I'm going to take this back to kind of this 5-day, 5-minute time frame. So what I was looking at when I put this particular trade on was putting this iron condor on somewhere up in this range here, with that as my level of support and my level of resistance up around this area here. And I was expecting that by the end of the day that the S&P 500 The XSP index was going to be kind of right in the middle of this range. And guess what? It didn't get there. It hasn't yet. It moved out of that range. So if we go to the trade tab, I'll show you where we created this trade. So here's the XSP, currently sitting at 669. I went to the 0 days till expiration option expiration, meaning this trade's going to be done and it's going to be worth intrinsic or nothing at the end of today. Now, I want to just say this about 0 DTE options. 0 days till expiration options. They carry with them substantial risk, especially given small price movements. Gamma, the option Greek that determines the rate of change of delta or measures the rate of change of delta, gamma becomes a much more significant issue in that last day to go until expiration, because there is no more time, essentially beyond today, for the price to come back if it starts to move. So price of the option can move very, very quickly one way or the other. Gamma becomes a significant issue close to expiration. So that is one of those potential risks. So be aware of that fact. Be aware of the fact that there is substantial risk in trading 0 DTE options. But at the same time, every single one of these options expirations will become a 0 DTE option at some point if we hold it to that point. So the idea of trading a 0 DTE option around the concept of price movement and around the concept of that last trading day becomes one that is, something to pay attention to as far as the strategy is concerned. So here's what we did. We sold, and you can see the in the money side now. I sold the 672 strike put, and I bought the 671. So I created a one strike wide vertical spread, short put vertical here on the downside. And I created a one strike wide short call vertical here on the upside, on the call side, at the 675, 676 level. So if we go back to the chart, my short legs were 671 and 675. Kind of had about a $4 range there, a 4-point range, in which we wanted this to move. So here's where I created the trade. And let me grab my annotation tool really quick, and we'll just draw this in here. So 671, that was my short leg on the downside. 675 was my short leg on the upside. So in fact, this was the range here that I was expecting price to stay kind of within to get the biggest gain out of this trade, to get the theoretical maximum gain. Now, this goes back to the discussion that we had about short options suffering from early assignment. If we were doing this with equity options, and this on the last day to go till expiration, my put spread, the one that I created right here, that one went so deep in the money here, as this one has, it's very likely that that's going to get assigned early, prior to expiration, maybe even in this early in the morning in the last day of this expiration. But given the fact that this was an index option, it's now sitting fairly deep in the money without that risk of assignment. Now, we have to do something with this, however, because if we were to let this option go all the way through expiration, then that assignment and exercise process is going to take place theoretically automatically, and we're going to suffer potentially that maximum theoretical loss on one side of this iron condor strategy. Now, the other side of that coin, though, is as the price of the star or the price of the index has gone down, this short call vertical spread has now gone to just about zero, theoretically zero. Okay. Now, on index options, Vivek, that is the case. On index options, those assignments take place after market close, because that's the only time at which an index option can be exercised is at expiration. But if these were equity options, and that's why I'm illustrating the difference here, if these were equity options, there is the potential that those could be assigned early prior to expiration, especially if they are in the money. That gives you a greater likelihood of that scenario happening. These are index options that we're creating, so that's why I'm illustrating the difference between these two. All right. So now, as we get to this point, this option, or this vertical spread up here, the other side, that call side of our iron condor, is approaching zero. This one is approaching max theoretical loss. So let's go back now that we can kind of see what this looks like and where this is positioned. We can go back to the trade tab and we can see that this one is in the money. This one, the call side, is out of the money. So then we can go back to the monitor tab and we can say, oh, look, this one right now, the call spread, that short call vertical spread that makes up the upside, the top side of our iron condor, is trading for just about zero. We've got a 10-cent or a 1-cent mark and a 1-cent mark on both the long and the short leg. So that's essentially trading for zero, right? Okay, so Vivek, yeah, those assignments are going to happen after market close on that day. But if you get assigned early, you could get an assignment notice. If it's an equity option and it's American style, you could get that assignment notice prior to expiration. There's no requirement that that's only going to happen after expiration. It can certainly happen, and you can get that notice prior to, if somebody were to choose to exercise their right, and then you would be assigned that obligation. So that's something to pay attention to. And by the way, that's something that Barb talks about in her Getting Started with Options webcast series, is that process of assignment and exercise, so being aware of that. So now the other side of this coin, though, is you notice what our put spread is trading at here. The short put has gotten significantly more expensive, as has the long put that made up the other leg of this trade. Okay. All right. So what we're looking at now as we get close to expiration here is taking theoretically our maximum loss in this trade, because at this point we sold that iron condor spread for 42 cents. 42 cents against a dollar wide vertical spread on either side left us with a max theoretical loss in the trade. If we think about what that number looks like, $1 minus 42 leaves us with 58 cents of max theoretical risk. And if that's the case, if we were to close this trade down right now, if we were to right click and create a closing order to buy this back, there's still a little bit of time value left in this spread. Okay. There's still a little bit of time value left in this spread. So what we're going to do is we're going to manage this as we close this trade down, as we get now down into the last hour of trading, or the last 38 time frame, or the 38 minutes of time frame here. We're going to look at managing this iron condor. And the way that we're going to manage this iron condor is two ways. One is I'm going to close down the leg. I could close it down entirely by itself. The first thing I'm going to do is I'm going to try to close down the leg that is essentially worthless at this point. And we may have some success in doing that. So what I'm going to do is I'm going to buy back that call option. And if there's zero bid there, then this is going to be a difficult scenario to be able to close this down. But here's the problem, or one of the challenges with this, is if the market starts to rally close to the end of the day, this option, if we were to just leave this and say, you know what, I'm going to whistle past the graveyard, and I'm just going to leave this one here, this 675, 676 short call vertical, because it's likely to expire worthless, which at this point it is likely to expire worthless, but that's not a guarantee that it's going to expire worthless. There is the possibility that the market could come roaring back and now threaten this side of the equation. So as we do this, what we're going to do is we're going to click on confirm and send. We're going to try to close this side down and see if we can at least get this side to close down. Now it's at 0 bid, so this may not fill, but this is a fairly liquid product, and we may get a fill on this to try to close this down, and we'll see if that'll fill for us. It may just hang out there and sit. That's one of the challenges here. So we may need to bump this order a little bit. And again, in paper money, we're most likely going to get filled, since it's paper money, most likely get filled at the midpoint. But what I'm going to do is, to ensure that I get filled in this, or to increase the likelihood of getting filled, I'm going to bump this limit up a little bit. I'm going to say, look, I'm willing to give it to the natural, which is 2 cents, maybe even a little bit more. I'm willing to buy it back for a nickel and potentially get out of the trade. And that may make it attractive enough in this circumstance for the market makers to fill these and close these far out of the money legs down, even though we're close to the end of the day. So I'm going to click on confirm and send. We're going to read through this order. We're going to make sure that that goes back in our index options group. And I'm willing to pay that nickel to buy this back. And so I'm going to click on send, and we'll see if that fills. It may not fill. Okay. It may not fill. Now, I want to just weigh on in this, and I appreciate Barb answering these questions. The probably very likely the largest number of assignment notices are going to come after the market close, because that's when the market now is done and those assignment notices can be submitted, whether it's the last day of expiration or not. But some people will look to close trades down prior to the end of the day. And the other circumstance might be somebody placing an inadvertent order, and you might get an assignment notice from that. And that can happen, and you can get that assignment notice, as Bruce reminds us again, whenever throughout the day. You can get that assignment. There is not that circumstance. You can get that at time that happens throughout the day. I've been assigned during the middle of the day as well. So just want to make sure that we're clear on that characteristic. So we're going to watch that and see if we need to bump that. Open interest, Roland, is not the only problem with getting with orders getting filled, because even if there's low open interest, if there's premium there, the market maker will respond to that marketable order. And in that particular case, they're not going to be necessarily kind when it comes to the bid-ask spread, but they may fill the order. Now, there's a great likelihood of the order getting filled when there is a big pond and you are a small fish. If you are the only fish in the pond, you are the pond, and it becomes more difficult for that order to get filled, but it's not impossible. All right, so let's look at, while we've got that order out there, let's go back to our monitor tab. And now what we're going to look at doing here is seeing what we can do to close out the side that's being threatened as we're getting close to expiration, and recognizing that we're very likely to get our max theoretical loss here in this particular case. So we're going to buy that one back, the put vertical back. And we're going to have to buy that back, and implied volatility is rising a little bit. Now, this gets into a timing issue, because as we get close to the expiration, if the market's been moving back to the upside, implied volatility is going to come down, and you can see that this is starting to kind of waffle back and forth here. So I'm going to try to buy this back for a little bit less and look at potentially taking that max loss here. But I'm willing to do that because I don't want to leave this all the way through till expiration. I could, but in this particular case, and again, remember, this is a cash settled index. I'm not going to have to deal with, if I get put the stock, this is simply going to be cash debit from the account, or credit if I'm in the money and I'm long the option. So I'm going to go ahead and I'm going to try to close this side down. We're going to put this back in our weekly options. And so we're closing this trade down, and this one filled right away because that's beneficial for the option market makers to close that. So now we don't have that side that's being threatened anymore. And this one is not such a concern. in this particular case. That might not fill, that order to close it down might not fill, but we run the risk still in this particular case in leaving this out here that the market could come roaring back. Is it likely to? Probably not. But it could come roaring back at the end of the day and end up here above our short call vertical. So something to pay attention to in managing iron condors. I wanted to do this to illustrate the techniques for managing not only a zero DTE option that's gone against us, but also an iron condor trade where the price of the underlying has gone significantly one direction or the other outside the expected range. And that is one of the risks of an iron condor trade. So I wanted to use that as an example in both of those circumstances. Now, the next thing that I want to do here is I want to come back to our index grid. And this is, again, another grid that is linked in the description for this page. But we're going to go back to our monitor tab, and we're going to take a look at our weekly strategy. So the strategy for this, for those of you who are brand new to this webcast, is very simply this. 14 days to go until expiration, we sell a short vertical spread on the SPX, and we sell it at one standard deviation, at that one standard deviation range. And then 7 days later, we buy it back regardless of what it's trading at. So we sell it at 14, buy it back at 7, regardless, come what may. And the intent is to gain 80% of our max theoretical gain in the trade on an ongoing basis. And we do it again and again and again and again. So 14 days ago, or 7 days ago, last Wednesday, I sold the 63.60, 63.10 short put vertical spread. Here we are 7 days later. I sold it for $1.30. It is now trading for 30 cents. So it's given us $1 of premium that we can collect here, that we can keep if we were to buy this back for 30 cents. It's done a fair amount of the work that it can do. Now, every time we do this, somebody asks the question, well, why don't we just leave it all the way till expiration? And the reason that we don't leave it all the way till expiration is because this is going to kind of take a long time for the remaining time value to decay away, and we still run that potential risk. So this is not just a volatility trade, not just a directional trade, but this is in fact a time decay trade. Because we're selling it far out of the money, the rate of time decay is faster initially and then slows down. But that benefits us because we can sell premium and then buy it back, hopefully, theoretically, for less than we were paid for it to begin with. So the first thing that we're going to do is we're going to close this one down because it's done what we expected it to do in this particular case. So I'm going to come in and I'm going to create a closing order and we're going to buy it back. And in this case, we're going to buy it back for about 35 cents. So we'll go ahead and click on confirm and send. We'll put it back in our options weekly group. Make sure by reading the order buyback to close the trade. And we're going to go ahead and click on send and fire that order off. And we're out for 30 cents. So we collected $1 premium. We collected $1.30 premium. We get to keep $1 of that premium in this particular case. Now let's go back to the chart and let's initiate the next trade here. So again, for those of you who are brand new to this particular strategy, our direction indicator is this. Our direction indicator is this. It is in this case, the 200 period moving average. And when the index is above the 200 period moving average, we sell put spreads. When the index is below the 200 period moving average, we sell call spreads. It's just that simple. The index is above the 200 period moving average, so we're going to sell put spread here. Now, in my next grid over here, I have at that one standard deviation cone. It's called the probability of expiring cone, and it's set at one standard deviation. So I'm going to do this. I'll run through this. We're going to go out and see which expiration is our 14 days to go until expiration. That's the 5 November expiration. We're going to go back to that chart, and I'm going to use a tool that's in our drawing tools. It is the time level. And so I'm going to come across the chart here, and I'm going to put a time hack at 11:05, at November 5th. That's my November 5th cross between the date and that one standard deviation range. So 64.65 is where I'm doing that crossover. So I'm going to put a line there. I'm going to put not only that time hack, but I'm also going to put that crossover there. Okay. So all of those little yellow lines are where we have sold these vertical spreads in the past. I've just left those lines in place as this is gone, so you can see where those vertical spreads have been placed as we've been moving up in this trend. So all those little yellow lines every week have been where we have sold those vertical spreads. We sold that vertical spread up here, and then we sold last week's vertical spread right down here. Those are the horizontal lines, exactly. Those are where we've placed those vertical spreads. Okay, so here's where we're going to place this vertical spread, 64.65. That's the short strike. So we're going to go to the trade tab. We're going to go to our 5 November expiration, and we've got to add some strike prices to this. I got to go out to about 120 strikes. And so we're going to go to that 64.65, which is going to be right. We don't have a 64.65. So we have a 64.70, which is a little bit further in the money. That's okay. Or a little bit closer to the in the money position. That's okay. I'm okay with that. And we're going to make this 20 points wide, 64.70. And we're going to make it 20 points wide. So we're going to sell, remember, this is a put spread. This is a short put spread. So we're going to sell the 64.70, and it's about the 17-cent delta. And then at the same time, and I'm using my control key, I'm going to go to the 64.50, and I'm going to buy the 64.50. And because implied volatility is a little bit higher than it has been, the market is a little bit more volatile, we're bringing in about $2.15 of credit. Last Wednesday, I brought in $1.30. This Wednesday, with higher implied volatility, I'm bringing in $2.15, thereabouts. So we're going to go ahead and we're going to create that order, and we'll see what that looks like in this particular trade. So that gives us a max theoretical gain in the trade of $220. If that expires worthless, we know that we're not going to get that. We're maybe going to get $2 of that. And we know that our maximum loss, if the price of the index were to move through, all the way through our short vertical spread here, so to be all the way below 64.50 at expiration, our max theoretical loss would be somewhere around the $1,780 range. So from a risk to reward standpoint, doesn't look great. From a probability standpoint, on the other hand, looks pretty good, at least given those probabilities as expressed here from a technical analysis perspective and an implied volatility perspective. So I'm okay with that kind of skewed risk to reward here, given the idea that it may take a big move in the price of the underlying index here to get to that point where we take a max theoretical loss. So I'm going to bring this to my index options weekly group, and I'm going to fire this order off, and we're going to see if that fills. And it may take a moment for that to fill. We may have to bump that number a little bit. Let's see if we can come in here and bump that, right click, cancel, replace. And when I say bump, it means I'm just willing to accept a little bit less for this trade. I'm going to put this down here to 205 and click on confirm and send, and we'll do it again. We're just going to work this order a little bit. Happy little order. We'll just work that order just a little bit. And we sold it for 210. Okay. All right. Now that we've got that in place and we know where that is, our expectation is that at 7 days to go until expiration, which is going to be the 29th of October, that's going to be our 7 days till expiration. That's going to be next week. We're going to buy that back regardless of what it's trading at, and we're either going to see some gain, most of the gain, some loss, or total loss in the trade. And that's kind of the nature of this particular strategy. And the intent for this strategy is simply to bring in premium, right? And thanks for coming, guys. You know what? To be honest, Jerry, I don't. The idea of a walk limit order is giving it a range. It's basically automating the process that I just did, which was bumping that order to try to get it to fill. So I know we've got a couple of webcasts that talk about walk limit orders, and I'll show you where to see some of those resources here in a second. Now, before we go, I wanted to address a couple of the questions that have come up here. So what we've got now in this trade is, if we come back down here, we closed this one down. We brought in all but 30 cents of that trade. This one we sold for 210. We want it to get cheaper. And in fact, it's not getting cheaper. It's getting more expensive. So that's but you see what's going on with volatility as we get close to the end of the day here. As we get close to the end of the day, that volatility is bumping around. So I want to answer a couple of questions on this strategy. One, why 20 points wide? 20 points wide is not a recommendation. It is simply what we have been doing consistently to balance risk and return. Could you do wider? Yes. Could you do less? Yes. It shifts the probability and it shifts the return on risk. Going closer is going to mean that spread is going to bring in less credit. Going wider means it's going to bring in more credit, but the max loss is going to be more. So that's how you adjust that and see what that looks like. Is wider or narrower. We know where we're going to place it at 1 standard deviation because that's the area in which the price of the index is not likely to be if we're selling outside that 1 standard deviation range. I want to answer one other question that came up, and is there a comprehensive list of European style indexes? And in fact, there is. If we go up to the Market Watch tab and you click on the public watch lists, you can come over here and you can see the list of American style indices. So that's in the public watch list. And if you come down here, you're going to see the list of European style indices as well. Okay. So that's listed in here as well. And those are in the publicly available watch list. I don't even have to create those. Those are just right there. And so we can open that up and you can see what those European style indexes are right here. Now, I will tell you this, not all of them are liquid and not all of them trade options. Well, not all of them have liquid options to trade. So that's something to pay attention to here in this list as well. Let me show you some resources as we kind of roll out of this. If you want to learn a little bit more about these strategies, index option strategies, zero DTE strategies, assignment and exercise, all of those things, this is the place to go. Trader Talks webcast page. You can just go to YouTube and search right here for Trader Talks webcasts, and you're going to get to this page. When you get here, to make it easier the next time, click on subscribe. All right. Click on subscribe. That way it becomes easier for you to find it as you search again. So let's do this. Let's go iron condors, for instance. And you type in the word iron condor and you're going to see a bunch of webcasts, including Barb's webcasts, that talk about iron condor trades. Zero DTE iron condors, I've talked about them before. You scroll down here, here's me talking about zero DTE condor example ahead of the Fed, those types of things. So you're going to see a lot of those resources here. And then the other resource is this. If you come to schwab.com/coaching, you're going to get to this overview page, this landing page. To see the schedule of live webcasts and indeed those virtual workshops, you're going to come right here and you can see those virtual workshops that are happening. Here's that virtual workshop. Here's where that's appearing right here. If you were to come in here and see 3 more events, here's today's virtual workshop. Oh, it's right down here. Where are we? No, we're on today. There we go, the 22nd. So we open it up. There's today's Advanced Option Strategies virtual workshop. We'd love to have you join us for that if you want to. And if you want to join us for one of our live events, come over here to our in-person events link We're going to be next in Anaheim, California on November 22nd doing a market drive event. And then in Houston, we're going to be doing a technical analysis and option strategies workshop. And then in Miami, we're going to be doing a live in-person advanced option strategies workshop as well. We've got a few that are over the horizon into next year as well. And by the way, very soon in the next couple of days, you're going to see a couple of advanced options live workshops for next year start to populate in this calendar as well. So we would love to have you come and join us for those. And those are at no cost to you. We'd love to have you join us for these resources, subscribing and following us here. That's at no cost to you either. And we would love to have you join us for all of our great webcasts and content. Guys, thank you very much for joining us. My thanks to Barb Armstrong for helping out today. And thanks to all of you and our great reviewers and our great production staff for helping to bring this webcast to you. We'll see you again next Wednesday for more trading index options, and I'll be back again in just a couple hours for our advanced option strategies virtual workshop. We'll see you then. Take care, everybody. Bye-bye.